So you do expect some sort of rally by year end?
I think so. Yeah, I think August and September have traditionally been weak months for the equity market historically, and with rates having backed up at the same time, that all aligned to kind of cause this correction that we've seen. But I don't see it as part of a long term downtrend. I think that the stocks are now reasonably oversold and have room to rally, probably at least back up close to where they were in July.
The latest payrolls data certainly beat estimates, but does it actually indicate that the economy is headed for a boom, or maybe underneath the hood, a slowdown is coming? Let's dig deep into the labor market with our next guest, Sam Burns. He is the Chief Market Strategist at Mill Street Research, and we'll be talking about not just his macroeconomic landscape outlook, but also oil and the equity markets. Shout out to our sponsor first today, iTrust Capital, an IRA that offers 35 crypto assets and physical gold and silver. iTrust offers 1% trading fees, the lowest in the crypto IRA space. So if you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David to learn more and get started. Sam, welcome back to the show.
Hi, David. Good to see you again. Thanks for having me on.
Last time we spoke, we aired our last interview on August 28th. Since then, the equity markets have been trailing downwards. We'll talk about that. But first, let's talk about Friday's jobs report. Huge gain in payrolls, 336,000 jobs added, beating expectations by a considerable margin. But let's just break it down. Under the hood, you've got 66,000 jobs added for healthcare, 117,000 for manufacturing, 20,000 for retailers, 21,000 for private professionals, 73,000 government jobs. So if you're looking at this from a less bullish angle, you could say that, well, there's a lot of government jobs added. It's not really private data. Private jobs, rather. It's not really, not all of them are full-time. So the economy isn't as strong as what it seems. Would you agree or disagree with that statement?
No, I think that's right. I think the headline number was very strong, but it doesn't necessarily mean the whole story was very strong. I think the breakdown, particularly the part-time jobs and things like that, suggests a little less strength under the surface. I think the average hourly wage gains suggest that the strength in the employment is not flowing through directly to higher wages, which has implications for the Fed. And the fact that the unemployment rate didn't go down, even though we had such a big jobs number, those are all kind of telling you there's still a fair amount of noise in the data. There's a lot of been labor unrest. All the writers came back to work from their strike. There's been a lot of things going on that can affect the data short term, month to month. My view is that the general trend is towards kind of gradually slowing growth in labor, but still keeping spending up. And I think the Fed is probably going to look at it that way rather than looking at it as a change in trend.
In terms of the number itself and how that impacted the markets, on Friday we had a huge gain also in the equities markets. Risk assets rallied across the board on the news. Is that surprising to you, given that in the past good news have been, I guess, sometimes interpreted as bad for the markets, if you assume that the Fed will react to that good news with more tightening?
Oh, yeah, that's right. I think I caught a lot of people off guard, and you saw the market sold off first thing in the morning, initially on the news, and then stabilized and turned around and gave a big rally. And that tells you a couple of things. One is that the underlying data below the surface wasn't as strong as it looked. I think the market kind of figured that out. And also that the market had already been down going into the meeting, both stocks and bonds, which in bonds rallied too, and we're fairly oversold going into this. So I think, the positioning going into the report was much more negative than maybe in some previous reports. And the fact that the Fed has already moved so much and has been kind of, mixing its messages a little bit more, saying that they're open to more rate hikes, but they're probably not going to raise much more. And that they're less inclined to respond to a single month's report, meant that the markets could kind of look past this and see good news that people have jobs, good news that their wages aren't going up too fast and therefore not really inflationary growth. That's kind of a really good scenario. And so, if stocks were already oversold, they had room to rally. And actually, even so did bonds, even though they've been in kind of a bear market for quite a while now.
Oh, so given the latest numbers and the numbers before that, where do you expect the labor market to head going into the end of the year and into Q1 2024?
Yeah, I think there'll still be some, gradual slowing. I think the labor force has grown as well as the actual number of people employed. And I think that's starting to balance things out a little bit more. I don't think we'll see the same kind of blockbuster job gains or wage gains that we saw earlier this year or last year, I don't think it's going to fall off a cliff. I think it'll just kind of gradually slow down, and we'll get back to more normal kind of pre-COVID growth rates as we get into the first quarter of next year. I think the Fed's kind of looking at that as well. So they're not as inclined to have to feel like they have to jump at every sort of single monthly positive report. And so my guess is they probably won't raise rates any further for this quarter or next quarter. And but we'll keep up kind of that hawkish messaging to make sure that people realize they're still on the case for inflation until the reported numbers come down a little further.
Yeah, well, the fact that we had a huge jobs gain, I mean, despite what it may seem on the surface, and despite what may be beneath the surface, which is weaker data, it still strikes me as companies aren't laying off workers, because if they're adding workers, you're not laying them off en masse, right? That shows me that companies still have enough earnings to sustain labor market growth to add to their headcount. Do you agree with that?
Yeah, that's right. And we've really seen that earnings estimates and earnings trends have held up remarkably well. Even here now, just about with Q3 earnings about to start, we'll start to see some of what the companies say about what's happened with rates and everything else. Yeah, they're still adding to payrolls in a significant fashion across a number of different industries. That tells you they're not seeing weakness in end demand and looking to try to cut costs by at least reducing hiring even yet. So the first stage is to cut back hiring. Then the next stage would be layoffs and wage cuts. And we haven't seen that really developing at all so far. So I think we're still a good ways away from kind of the real sources of weakness there. And it's just a matter of moderating the growth rate. And that corporate earnings are telling you that they're expecting pretty good growth next year for the most part among analysts. So there's no real demand side reason to be cutting people from payrolls right now.
Well, do you think higher interest rates, should they stay higher for longer, will eventually weigh down on companies' earnings as maybe their debt rolls over or they just can't sustain interest payments at current levels?
It'll definitely have a slowing impact. But again, there's kind of offsetting effects there. Some of the large companies have a lot of cash and they're earning more on their cash holdings than they did before. So there's interest income and interest expense. And for kind of corporate America as an aggregate, particularly for the larger caps in the S&P 500, there's a lot of offsets there. So I think that interest rates will slow things down over time, but it'll be more of a rotation among different types of stocks and different companies and industries. The ones that have a lot of interest rate exposure are going to struggle. The ones that have less debt, less interest rate exposure, or are holding more cash, are seeing some benefits from higher interest rates. They get to earn more on their cash. So to me, it's more of a rotational effect rather than an overall negative effect, given that there's still positive demand. And again, I think that's partly fiscal policy helping keep things kind of counteracting the monetary policy.
Okay, so bottom line, do you expect another hike by the end of the year?
I do not, no. I think the Fed will talk about it, but they won't do it.
What about next year?
Yeah, once we get past the end of this year, my guess is that inflation will be low enough that it'll be very hard for the Fed to make an argument that they need to keep raising rates for inflationary purposes. My guess is that inflation will be, in some ways, it already is close to 2% if you adjust for housing. But even if you don't, I think by the end of this year, early next year, you will see the reported numbers be much closer to the 2% target that the Fed is talking about. And therefore, it'll be very hard to say that a 5.5% interest rate is too low. I think it'll actually look too high at that point. And real rates are still solidly positive now. So I think the fact that the long end of the Treasury market has yields have risen, the Fed is glad to see that. The market is doing their job for them. It's catching up to where the Fed wants to be, and therefore they won't have to do as much. They've actually made comments to that effect recently.
Both core and headline inflation will head lower towards 2%, Sam?
I think so, yeah. I think the housing component is what's really going to drive it lower, given that that's got the lag in it, and it's going to be working its way lower. I think everything else will kind of generally be slower as well. So except for maybe oil spikes and things, I think it's going to be generally a trend towards 2%.
Yeah, let's talk about oil in just a bit. We are going to come to the energy component of headline inflation. Let's talk about the markets now. Turn to the markets. The S&P 500. Last we spoke, the S&P was at 4,500 points, which was late August. It's been trailing down ever since, big spike up in the last couple of days, but generally the trend has been down over the last 5 to 6 weeks. Sam, what do you make of this downtrend? Is this the beginning of a larger bear market, or is this just a shorter term correction?
I'm probably more in the correction stance. I think it just doesn't look like a bear market to me. I think the peak we saw in July that we've seen a pullback from, didn't look like a really major significant peak to me. And the fact that earnings are still pretty good and earnings estimates are still generally rising, or at least holding steady, tells me that there's should be a floor underneath the market. I think the market has now gotten fairly oversold on a lot of measures. I think there's a lot more negative sentiment among traders and investors right now than there has been for the last couple of months. And I think that means that some of the bad news has been priced in. So my guess is that, and Friday's action actually is a good example of that you had what could have been interpreted as negative news and was initially sold off, turned into a big rally in both stocks and in bonds, which are both oversold. So my guess is that bonds will be able to stabilize here soon, and that will allow stocks to rally a little bit once the interest rate pressure comes off. I think this has mostly been a interest rate driven correction in stocks, not a fundamentally driven one. And so I think it'll once the interest rate pressure eases a bit, then stocks can rally back some.
Well, on the 26th of September, so a couple of weeks ago, the Dow notched the single biggest day drop since March. Now, we know what happened in March. It was the banking crisis. So nothing really has been dramatic since then. Was there a particular reason for these sell-offs that we've seen over the last couple of weeks?
Yeah, I think a lot of it has really been driven by the move in the long end of the bond market. And the fact, and then, earlier in September, oil prices were going up and people were concerned about that. Now, just in the last week or two, oil prices have corrected quite a bit, and then they bounced again this morning on the Middle East turmoil. But I think that the combination of rising interest rates and rising oil prices spooked people for a little while, for a couple of weeks there, and that's what provoked that correction in the Dow and the S&P. But now, like I say, oil is less of an issue. It's come down from where it was. Bond prices and yields have started to stabilize. And I think, let's say, the Fed story is starting to shift a little bit. So my guess is that those kind of shorter term influences will fade, and people will now focus again on Q3 earnings that are starting to come out here soon, and that will give the markets a reason to at least stabilize, if not rally.
So you do expect some sort of rally by year end?
I think so, yeah. I think, August and September have traditionally been weak months for the equity market historically. And with rates having backed up at the same time, that all aligned to kind of cause this correction that we've seen. But I don't see it as part of a long-term downtrend. I think that the stocks are now, reasonably oversold and have room to rally, probably at least back up close to where they were in July.
Correct me if I'm wrong, but aren't bond yields, especially the longer end of the curve, I'm talking about the 10-year, for example, aren't those usually positively correlated with the equity markets in the sense that the yield moves up alongside stocks? The reverse has been happening over the last couple of months. Ever since July, the 10-year yield has continued to climb higher while stocks have been down. If you see a sell-off in treasuries, which is what a higher yield suggests, wouldn't that also suggest risk-on appetite?
It can, yeah, that's right. And the correlation between stocks and bonds has definitely shifted back and forth over time, and it depends really on the economic growth backdrop and the inflation backdrop. If underlying real growth is stronger, then rates can rise even if stocks hold up. But if growth is weak, then you see the reverse. So we're in a relatively solid growth environment right now. So stocks have actually held up and outperformed bonds. If you look at the S&P 500 relative to, say, the TLT, the long-term Treasury ETF, stocks have outperformed by a huge margin this year, and even in the last few months. Even as stocks have pulled back, bonds have pulled back more. So on a relative basis, if you look at long-term bonds or stocks have been a better place to be, and that reflects the underlying economic growth and earnings that stocks benefit from that bonds don't. And I think that's the scenario we're in right now. Whereas in some past cycles, you had a weaker economic backdrop and low inflation, and that was really more an area where you needed lower rates to drive stocks higher.
Interesting. All right. Well, let's turn to the bond markets. We've you mentioned how you think the bond backdrop is indicative of economic growth. How is it related? Can you just, in layman terms, describe or explain how yields are related to growth prospects?
Sure. So there's the kind of first step, which is that people assume that if real growth activity increases, and particularly if it increases rapidly, that'll push up inflation. that more demand than there is supply will cause a rise in inflation. And that hasn't always been the case, but that's what people see in their data. When they see very strong data, they tend to think that inflation will go up, which means that you need to have a higher interest rate to compensate for that. So they'll sell bonds and push interest rates up. And certainly the Fed often will respond that way as well. They'll raise interest rates if they see strong growth in anticipation of a rise in inflation pressures. And then the other fact is just that, again, if you have a choice between owning stocks and bonds, you'll tend to own stocks when growth is strong and earnings are going to rise, because that benefits you as an equity holder. You get the benefit of stronger earnings. If you own a bond, strong earnings doesn't do anything for you. And so, and you have to worry about inflation, whereas inflation tends to kind of flow through into earnings, so that even if there is inflation, you'll get higher earnings as a benefit if you're an equity holder. None of that helps you if you're a bond holder. So you tend to sort of sell your bonds and buy stocks as an asset allocation choice if you're seeing strong growth, strong earnings, and the possibility of higher inflation. You get a better kind of outcome if you're in equities rather than bonds, typically, unless inflation is really a runaway sort of scenario, which hasn't happened in a long time. So that's kind of how you think about it, both from a Fed policy standpoint and inflation, and then also from a stock versus bond standpoint. If you're an equity holder, you definitely prefer to own stocks in a strong growth environment.
Is there a direct causation between interest rates and inflation? In other words, does one cause the other to move?
Not directly, no. Really high interest rates will usually slow the economy, and that will then cause inflation to fall because demand will kind of collapse. Once people start losing their jobs and losing their income, they just can't afford to buy stuff anymore, and then inflation will come down as a result of that. And that's what happened certainly in the 70s and 80s and some of the other cases where the Fed aggressively raised rates and really slowed the economy down due to monetary policy, just to cause interest rates to be too high for businesses and consumers to handle. And so they had to cut back on all their spending and cause inflation to go down. That doesn't always happen and doesn't have to happen because it depends on the causes of the inflation. If inflation is because of too much demand, then you may have to slow demand with interest rate hikes. If it's because of a supply shock like oil or something like that, then higher rates doesn't really help. And so it can make things worse in some cases because it makes it more expensive to increase supply. So it depends on really the scenario of whether it's more of a supply-driven shock or a demand-driven shock. And I think right now we're seeing more, and during COVID, we saw a lot of supply-driven shocks that are now starting to fade. And that's why inflation is coming back down again. But I think higher interest rates do reduce demand in general, but it's a kind of a mixed effect because, again, people get more interest income, but they also pay more interest. So it depends on who you are and whether you're a borrower or a saver.
What about the other way around? If inflation goes up, does that directly, well, we know what the Fed usually does when the inflation rate goes up. They usually raise the short-term end of the curve, the 2-year yield goes up with the Fed funds rate. Now, what about the reverse? So suppose inflation comes down from, let's say, its highs. Interestingly, we don't see as much of a correlation there, at least not in the last cycle, right? Rates have stayed high, if not gone up, when inflation has been coming down. Why is that?
Well, that's right. This current cycle, the Fed has been sort of slightly lagged or behind the curve, perhaps a bit, in the sense that they didn't start raising rates until inflation was already rising pretty significantly. And now they've gotten rates up to a fairly tight, high level, and inflation is already coming down pretty sharply. And I think they're worried about their perception that they're going to look like they might have given up on fighting inflation too early before inflation is really fully vanquished. And so I think from a public perception standpoint, they're trying to keep their rates high and look like they're really aggressively fighting inflation before they are willing to shift gears and lower rates. Now, in the past cycle, sometimes it's taken a crisis or a real slowdown in economic activity or a banking crisis or something else to force them to lower rates all of a sudden. And then they'll kind of do so on kind of a crisis basis. But I think in this case, they might be able to get to a point where inflation comes down even further, and they'll say, well, all right, we don't need rates to be at 5.5%. Maybe they could be at 4%. And that would still be, above average, but not as tight as they are now. And so I think maybe that's what we'll get to next year. But they've definitely been more willing to keep rates high to fight inflation than to lower rates preemptively if they think inflation might come down, because they kind of have an asymmetric policy response, given that if they're wrong about inflation and it does go back up, then they look really bad. and they're really worried about that.
Well, let's talk about something else that we should have been worried about, or at least from a market's perspective, the government shutdown that never came. A lot of economists, including Goldman Sachs chief economist Jan Hatzius, were writing to their clients that there will be a very high chance of a government shutdown by October, if not later this year. It didn't happen. Is it still going to happen, do you think?
Well, I think the continuing resolution that they passed to get us through to November 17th, I think that will hold. So we'll get at least till there. The question is then, they kick the can down the road for 6 weeks, but once we get to that point in mid-November, then what's going to happen? And right now, of course, not only are the parties split in Congress, but the House is sort of dysfunctional because there's no speaker, which makes it very difficult to pass any kind of legislation of any kind. And I think they're going to have to very quickly move to get a speaker and then get some of these budget bills passed, in addition to things about Ukraine or Israel or other things that are going on geopolitically. So I think there's going to be a timing issue of how fast they can move and whether the Republicans in the House will hold things up or whether they'll allow things to move at a more rapid pace. So it could be that we get to mid-November and have the same problem of a shutdown again. But I guess they took the view, at least initially, that it was bad for them politically to shut down the government or be blamed for it. So assuming that is still the case in mid-November, they'll probably find a way to keep it going, and maybe they'll do another continuing resolution, or they'll do a proper budget bill to fund the government for the next year.
Ultimately, even if we do get a shutdown, suppose the bill doesn't get renewed somehow, does that have any impact whatsoever on the broader economy and ultimately markets?
Typically, no. This has happened a number of times in the past. Most of the shutdowns have been relatively short, so it's a short-term disruption. It makes everyone look bad and causes just problems for a lot of the federal employees, but ultimately doesn't really change economic policy because those are all set in the annual budget appropriations bills and things, and doesn't really affect the overall economy because it's not big enough or long enough to really drive the underlying economic activity. So it's really mostly a sideshow. It doesn't directly affect the underlying economy or earnings most of the time. And so it's just a kind of another example of government dysfunction, but doesn't really affect the overall economy too much.
Unless maybe government employees, I guess, quit and the unemployment rate goes up momentarily, or at least initial claims go up. That may affect the Fed's decision to raise or keep rates. I don't know. I'm just speculating.
Right. And certainly, they produce a lot of noise in the data. You might have a short-term spike, in claims if federal employees are laid off for a little while. I wouldn't guess that a lot of them would permanently quit, but that there would be a lot of noise in the data, and it would, might temporarily, reduce spending for a little while. And it definitely makes the Fed's job harder. And certainly, even if the people in the government at the Bureau of Labor Statistics or the Census Bureau that collect all the data to produce the CPI or GDP, if they're laid off for a few weeks, they won't collect the data, and the Fed won't have it to look at. So just the actual data itself can get messed up by government shutdowns. So I think it definitely made the Fed's job harder. I think they would be more inclined to kind of sit on the sidelines and wait rather than do anything dramatic either way, if they're not sure, if they, it's a foggier view than usual if the government does shut down.
Well, one sector, turning back to the equity markets, one sector in particular has had a really bad year, and in particular, a really, really bad last 30 days. I'm talking about utilities. If you just take a look at any index, like let's take SIXU, for example, utility select sector index, huge drop since September 14th. What happened?
Yeah, and there, what you're seeing, I think, is really the sensitivity of utilities to interest rates. The sell-off in the long end of the bond market looks a lot like the sell-off in the utilities market. So if you look at those charts together, you'll see a certain correlation. And I've actually done some studies looking back historically, and over the last 20 or so years, whenever long-term bond prices fell, meaning interest rates rose, the utility sector would underperform the market substantially in those months. So there's a very clear historical relationship between higher rates and lower utility relative performance. And that's really two things. One is the utilities as a sector tend to carry much higher debt loads because they're a regulated industry. They have higher debt loads and interest costs, so they're more sensitive to the cost of financing. And also they tend to be low growth, regulated industries that pay a high dividend rate, but don't really grow much. So if you're an income oriented equity investor, and then you look around and you see higher interest rates in the bond market, you might sell your utilities and go and buy a bond as a safer way to get your income. And so you might shift out of utilities and into bonds as kind of a way to allocate your assets. So both of those things tend to make utilities especially interest rate sensitive. And I think that's what we've seen lately. And again, there's not much kind of growth going on in utilities overall. So I think it's really a matter of the competition from interest rates.
But would you say the sector overall is oversold right now?
Yeah, it's probably oversold, much like the bond market is. So I wouldn't be surprised to see if the long treasury market starts to bounce a bit and kind of come off that oversold reading, that utilities might as well. But I wouldn't necessarily mean that it's a time to put a lot of money into utilities on a long-term basis. But I think you could definitely see a bounce on a short-term basis for sure.
Yeah, but I'm looking at the consumer staples ETF, for example, XLP, and that's had a huge decline since July. I don't know if that's just been following the equity markets overall, or we're just seeing sell-offs in defensive sectors, meaning more risk-on appetite. What do you think is going on?
Right. I think there's two things. And yeah, one is that the markets have pulled back, and so all the equity sectors have pulled back as well. I think some of the defensive sectors have been under pressure as well, just because I think the overall trend is still net positive. So those low beta sectors are not getting as much demand. But also, consumer staples does have some sensitivity to not just rates, but oil prices. That a lot of the packaging and things like that, and the trucking and transportation that goes into moving all those things around the country have an impact on the cost structure for a lot of staples companies. And so I think that that's filtering through to some of those companies as well. So I think it's partly just the market pulling back, and partly people worrying about some of those input cost pressures on a sector that may not see a lot of overall top line demand.
Let's turn to oil and energy now. Like you mentioned, oil has played a contributing factor to headline inflation. What's your read on oil? Huge bounce today, most likely in response to the escalating tensions in Israel. Is this a short-term bounce, or are you probably long oil at this point?
Yeah, my general view on oil has been that the natural supply and demand globally would be sort of for flat to lower oil prices. That there's a lot of more production, even from the U.S. and non-OPEC countries, and China's demand is relatively low relative to what it had been in the past. But you've had OPEC really cutting back on supply aggressively for the last 5 or 6 months, in addition to Russia's supplies being more limited. And then, over the weekend, you've certainly seen a bounce in oil caused by the tensions in Israel that might affect some of the oil-producing countries over there, like Iran. But the fact that oil had come down pretty sharply from sort of mid-September through the last Friday tells you that even those supply shocks that we've seen up until this weekend are really not enough to make a long-term sustained move in oil. There's a lot of oil supply around still, and demand isn't really growing. And actually, gasoline demand in the U.S. seems to have been weakening, and that's caused refining margins in oil for oil producers to be cut pretty sharply lately. They're down at about 18 months lows now. So the demand picture is not very strong for oil, and it's really only supply shocks like OPEC or unrest in Israel that are causing these sort of short-term bounces. I don't think they're going to be sustainable. So I've been kind of underweight energy stocks for a while now, and would be hesitant to really try to chase oil at this point.
Would any level change your mind? Like, suppose WTI breaks above $100, would you be more bullish?
Well, certainly, yeah. If it looked like the long-term trend was really kind of turning and breaking out, and that it wasn't, if I saw oil rising without a big shock, kind of news headline to drive it, that would tell me that the demand and supply balance would probably have really shifted. And you'd probably see that in some of the data. You'd see that in the the Energy Information Administration data, or other signs of demand globally for oil and or reductions in supply. But I haven't seen that so far. So it would require some kind of activity like that to really kind of shift my view to think that there's really kind of a true underlying demand for oil, rather than these kind of episodic supply shocks. And then even things like natural gas and other metals and other parts of the commodity space are kind of flat to lower mostly. So it's not a broad-based commodity demand. It's just oil kind of diverging from everything else because of these supply shocks. And again, if I saw broad-based commodity demand, I'd be more inclined to think oil had legs, but I don't really see that as either.
The dollar. Let's talk about the dollar finally. The DXY again, huge strength in the last 2 months. Was that really just trailing the 10-year?
Yes, that's right. I think the dollar has really been, sensitive to the rate policy in the U.S. and the fact that long rates are now catching up to where the Fed on short rates have been, and that means that the dollar is more attractive from an interest rate standpoint. You've also got the fact that economies globally in Europe, China, elsewhere, are relatively weaker than the U.S. So, if money's looking for a home in terms of economic growth, the U.S. still looks pretty good. It's still the strongest economy of the major, really big economies right now. So I think that's been attracting money to the U.S. So I think the dollar's had a big run. It's maybe going to consolidate here for a little while, but there aren't any other currencies that look much more attractive than the dollar right now. So if you're worried about risk, you probably want to own the dollar. If you want economic growth, you probably want the dollar. If you want higher interest rates, you probably want the dollar. So not much reason to sell it at this point.
Would a recession be bullish or bearish for the dollar? On the one hand, a weakening economy might see yields move in the opposite direction, bringing down the dollar. On the other hand, and of course, if the Fed pulls back on rates, that could also mean different interest rate differentials between other central banks that could weigh down on the dollar. But on the other hand, a flight to safety could mean bullish news for the dollar. So which is it?
My guess is if we saw a recession, it probably would hurt the dollar, at least for a little bit. But yeah, again, it would be a matter of if it's a global recession, all currencies are going to look weak economically, and then it's which central banks are going to be more aggressive in cutting rates rather than raising them, which is what they've been doing, in the last year or two. So I think that, and then you're right, a dollar is typically a risk-off currency. If people get nervous, they go to the dollar. And so unless there was something systemically specific about the U.S. that was relatively weak, like in 2008, that was a concern that the U.S. banking system was going to fall apart in the mortgage market and everything. So it made people nervous about the dollar for a while. But I think unless there was something very specific to the U.S. that was weak, rather than global slowdown, I think the dollar would hold up or even benefit if there was a global slowdown. So yeah, I think the dollar still has a bid to it either way, but it would only be if something specific to the U.S. and a big policy mistake potentially would cause people to want to get out of the dollar.
Perfect. Well, Sam, excellent analysis and insights as usual. Final question before we close off. Which I think I asked you this before, but what would change your mind on your bullish outlook? Let me rephrase this question slightly differently this time. Any potential risks out there looming on the horizon that would add to volatility? Any macro events, any geopolitical events brewing that could potentially add more volatility?
Yeah, in my mind right now, it's really that policy mistakes are going to be the thing that is going to cause more problems, and that's typically what's been the case one way or another historically. That you basically get too much monetary tightening, too much fiscal tightening, or other kind of policy mistakes. Where the government changes the rules or cuts back on spending too aggressively, things like that. So my worry is that the kind of dysfunctional U.S. Congress, or even in other countries, that the leadership makes mistakes, economic mistakes that are significant enough to really cause recessions or disruptions in the banking system or other things like that, that would cause markets and the economy to really slow down in sort of an unnatural way. I think there's a greater risk of that now, or probably going into next year, than there has been, given that the U.S. Congress is very split and dysfunctional right now, and that the macro fiscal policy that's been supportive of growth so far is probably going to fade at some point, and you won't get any new support from that. And so those kind of things tell me that there's some greater risk that policymakers will try to cut spending or raise rates or do something else that will then cause the economy to slow more than they want it to, and they won't be able to fix it.
Thank you very much, Sam. Appreciate your thoughts. Where can we learn more from you and Mill Street Research?
Sure. So certainly follow Mill Street Research on Twitter. I've been posting comments there pretty regularly. Also on LinkedIn, post comments and interviews there. And then certainly millstreetresearch.com is the website. There's a blog there. There's sample reports. So you can find out a lot more about what Mill Street does.
Perfect. Well, we'll put the links down in the description down below. Make sure to follow Sam through those links. Appreciate it once again. I'll speak to you next time.
Great. Thanks very much, David.
Thank you for watching. Don't forget to like this video and subscribe.